I think that the fiscal deficits and monetary policy are very big. Some of the other ones are factors that, like obviously the war situation could be very impactful, but as a base case, it obviously impacts human lives and it has all sorts of impacts. But investing speaking, unless we see, for example, major oil disruption and things of that nature, which so far the various powers have been generally hesitant to go after. So that is an ongoing kind of minor inflationary force. I mean, as long as the Suez Canal and the Red Sea is risky to navigate, and as long as we have these frictions of Russia sending their oil to other countries that are then, sending it to Europe and elsewhere and kind of just adding to the logistics of this whole thing, that's a minor background inflationary force on the global economy. Tariffs, that's obviously a very big election outcome potential. The Biden administration has kept up the pressure on China, but we could see an acceleration under the Trump administration, or we could see it used as a negotiating tactic to see how that shakes out. In general, I think that that's something we probably get to a little later next year. One of the big things that I'm watching for the first half of next year, which I don't see a lot of people talking about yet, is the debt ceiling. And so the debt ceiling is currently suspended in the United States. And at the beginning of January, it'll automatically go back into effect, which means the Treasury won't be able to issue net new debt. And since they're running a deficit, to keep paying their bills, they have to draw down their cash balance, their Treasury general account. And they got about $800 billion in cash there, which is currently their target level. And so kind of like the first half of 2023, I mean, there's a debt ceiling issue in the first half of 2023, and they basically drained their entire TGA back into the financial system, which ironically is really good for liquidity when it's happening. Things get bad if they actually hit zero, but it's kind of like blackjack. If you go close but you don't go over, it's actually good for liquidity while it's happening. So whether or not we see a protracted debt ceiling fight in the first half of next year is one of the key variables that I think could influence market pricing. The sample size is fairly small. The debt ceiling's been around for over a century, but it's only been used politically for the past decade and a half or so. And historically, during that time, we had 3 Democratic terms, 2 Obama, 1 Biden, and we had 1 Republican term, Trump. And so far, the Republican, when they were in opposition, they used it pretty frequently against Democratic presidents, but we didn't really see it used much by Democrats against Trump, but that was only 1 term, so the sample size is pretty small. So from what we have from history, if you get a Harris win, it's probably more likely to see the debt ceiling be used again in the first half of 2025 to extract some concessions. Whereas if you get the Trump victory, which is currently where polling and betting markets are leaning toward, I think we'd be less likely to get it, but it's still certainly possible because it's not a big sample size of whether or not Democrats will use it against Republicans. Generally, a draining TGA is pretty good for liquidity. It's not the only variable that affects liquidity, but it's a meaningful one. In recent months, we're kind of at the lower end of workable liquidity in the system right now. So, for example, banks hit their lowest cash position back in March 2023 during the regional bank crisis. Ever since then, they've not dropped below that cash level despite ongoing QT. And that's because the reverse repo facility was drained back into the financial system. And that was in large part because the Treasury issued extra T-bills. They went above their normal allocation of T-bills, and that was able to basically draw money out of the reverse repos back into the system. That was good for liquidity. That's getting pretty close to being drained. They still have a couple $100 billion to go, but that's getting fairly drained. And right now, the biggest variable that matters over the 6 months that start at the beginning of the year is really what's going to happen with the TGA, because that's just such a big force compared to some of the other numbers there. For a while, the repo facility that the Fed has was not really used. At the end of last quarter, it was used by major institutions to the tune of about $2 billion, which is very little, but it is a kind of a trend change. So that's something I'll be watching to see if that quarter ends. We'll start seeing more usage of the repo facility because that's kind of indicative that there might be pockets of illiquidity in the system. During the first half of the Trump administration, the market was kind of rapidly pricing in tax cuts. They did tax cuts without, for the most part, corresponding spending cuts. So they basically did a stimulus when we already had an economic expansion. So it's kind of like rocket fuel. And then for the Biden administration, the first year was still fairly early in the recovery from the lockdown-induced recessions, combined with stimulus that started under the later years of Trump with the stimulus checks and then continued under Biden. And so those were both pretty notable. You would generally expect that if we get a Trump victory, probably the market starts pricing in another round of tax cuts of some sort. If we get a Harris victory, it's a little bit more complex because she has a mix of wanting to increase some taxes while keep others low. So we have to remember that some of the Trump era tax cuts automatically expire by the end of next year. I think we're seeing a rotation to some extent. We've seen a lightening from some of the interest rate sensitive industries. They're the ones that have been kind of more impaired in this. What's interesting is that by some metrics, we had a recession in 2022, even though we did not have an NBER defined recession. So we didn't have an unemployment cycle, but we did have a credit tightening cycle. So if you look at senior loan officer surveys, banks got as tight for credit as they normally do in recessions. We also had rapidly slowing loan growth as a result of that credit tightness. And if anything, we're kind of coming out of that now. So we've been in this environment. And also, if you look back at that 2022 period, consumer sentiment, recessionary levels, and the misery index, which is the sum of unemployment and inflation, that reached recessionary levels, obviously because of the inflation more so than the unemployment, which was pretty low. And now we're seeing there's less extreme negative for consumer sentiment. There's less extreme misery index. Banks are getting a little bit less tight with their credit than they were. So many of those are actually improving. But then the one variable that is starting to get pretty heavy is the whole unemployment situation. So continuing claims hit a new cycle high just recently. My general base case is that probably continues to inch up somewhat, but I do think that it'll probably reach a lower peak in this cycle than in many other cycles that we're familiar with. I think the 2001 recession is probably the closest recent analog that I would look at, which is to say a fairly mild recession, because in this current environment, when they're running 6 or 7% GDP deficits, we're in a fiscally dominant regime that can override some of the other factors and kind of change how a recession looks to some extent. So there's two types of recessions. There's a classic disinflationary one where it's negative, it puts downward pressure on demand and prices. Some percentage of people lose their jobs and they have very negative consequences from that, but the majority of people don't lose their jobs and are relatively unaffected. Then there's the more inflationary type of recession where the release valve is not really unemployment, it's debasement. This is more common in emerging markets where, the currency gets cut in half relative to the dollar. Everybody has more pain when they're buying anything, especially that's imported. I experience this when I go to Egypt. My family there, all the prices of everything are up, even though it's not really this unemployment cycle. And so when you're running really hot fiscal in a recession, you can dampen how disinflationary it is, and you can dampen the unemployment to some extent, but then instead it comes out in debasement and inflation, most likely. The election outcome is not my biggest inflationary variable that I'm watching. Probably the single biggest variable that I'm watching is energy prices. It's pretty hard to get a really inflationary cycle when you have energy that's relatively well supplied. So there's been, a decent amount of offshore supply, and OPEC Plus has some degree of spare capacity. And so as long as you don't have war, take out major oil facilities. We also have to see what Trump's going to do with Iran in terms of sanctions. So those are some of the big variables. The other big variable to watch, I think, is Chinese stimulus or lack thereof, because they're a more physical economy than the US. Their oil demand has been pretty muted lately for a variety of reasons. And they're the biggest trade partner with most countries in the world now. And so when they stimulate, they trickle out to a lot of other countries, just like the United States does. And so we have a very US-centric view often. And the US obviously does matter quite a bit. It's one of the two biggest economies in the world. It has all these implications. But when I look at the Harris versus Trump election outcome, there's a lot of areas where I think that's important. But inflation, it wouldn't be in my top two things that I'm monitoring. Generally, the energy situation, Chinese stimulus are kind of the top ones, followed then when we get down to election things. Things like tariffs and things like who's going to stimulate more, that kind of stuff. I think that the Fed policy is only partially looking at inflation. I think they're looking at other variables as well. Back when they were fighting inflation harder in the early 2023, when we had a regional bank crisis, they favored kind of saving the banking system over getting inflation down as quickly as they could. And now they're cutting interest rates while inflation is still above their target. It's down, but it's above their target. In addition, the Fed only has a handful of levers to deal with inflation. So what the Fed does with their interest rates is that they try to encourage more borrowing, like more credit creation, or they try to slow down credit creation, depending on if they're trying to stimulate or they're trying to fight inflation. And the problem is that in the current environment, bank lending is only a small percentage of money creation. The fiscal deficits are a bigger component of it. So back in the 70s, bank lending was a bigger aggregate amount than fiscal deficits, whereas now, they got bank lending to a very low level. Overall private credit growth, they successfully got it to a pretty low level, but that when they're running 7% of GDP deficits, there's still this high watermark that's hard for the Fed to deal with. So, and they're not really interest rate sensitive. If interest rates go up, their deficits get even bigger, and they don't really cut spending based on the deficits. And if they were to have dysfunction in the treasury market, you'd see the Fed step in and assist with it. So I think that that's one of the complicating things, is that when the factors of inflation are outside of their control. They're not exclusively looking at inflation anymore. And instead, they're looking at a holistic thing of inflation, banking system stability, treasury market stability. And so some of those things can lead them to be more dovish than you'd otherwise expect from the inflation data that they see. My base case is looking for at least 50 basis points of cuts. We'll see what the data says to warrant more of that. I try not to look too far ahead because the market, they'll price in 7 cuts at one point, and then like a quarter later, they're pricing in 3. And so instead, what I'm generally focusing on is, okay, we're expecting mild cuts. The problem is that doesn't necessarily translate into borrowing costs going down. We saw, for example, with this 50 basis point cut, long end yields went up. And that is historically pretty unusual in modern history for them to cut rates by that much. And then like the 10-year treasury and mortgages go up. That's close to what actually businesses and people are borrowing at. They're not borrowing at Fed funds. They're generally borrowing in the middle of the longer end of the curve, and their interest rates didn't really come down. We still have a partially inverted yield curve, which means that like short end cuts might not really affect borrowing costs. And an argument that I made earlier this year is that even when we get a fairly substantial cutting cycle, like let's say when we go down a total of like 150 basis points from the top, we're probably still not going to get a very big refinancing cycle, because so many people already locked in low long rate debts at even lower levels. So this will be the first cycle where we probably don't get a lower low in interest rates, either short end or long end. And that means that while it does help, say, small businesses, and it does help some of the unlucky people that took out mortgages at like the peak, it doesn't really result in this really big refinancing cycle. Same thing for investment grade corporations. A lot of them have locked in pretty long duration debt at low rates. And so interest rate cuts are not very impactful for them. Even some of the biggest names in the S&P 500, like Alphabet, for example, they have more cash than debt. And so actually lower interest rates, if anything, are mildly hurt them, because if they've locked in a little bit of long-term fixed rate debt, they're holding a cash balance that earns interest. And if we cut interest rates, they just get less interest income. And so we've got this kind of like top heavy system that I think is not going to be very responsive to interest rate changes. So people will be focusing on is by X date, is it going to be 50 basis points cuts? Is it going to be 75 basis points cuts? Is it going to be 100? And while that matters, I would generally argue that it matters less than people expect, because this is not a credit driven cycle. It's a fiscal driven cycle. And so the fiscal side is more impactful. So I think it does not matter that much for consumers that have assets and that already have a locked-in mortgage from the past cycle. So that locked in a mortgage under 3.5% or so. And then we look at lower-end consumers, credit card rates and things like that, where they borrow, they're way above interest rates. So in general, around the margins, I would say not that much. I would say that small businesses are probably more impacted by interest rates than the American consumer. Where I think U.S. interest rates, ironically, could matter the most is globally, because there are many other countries trying to protect their currencies relative to the dollar, and the dollar's got fairly high interest rates, and a lot of those other countries have more variable rate debt. And so if the US cuts its interest rates moderately, it might not impact America that much, because we've got a lot of locked in fixed rate debt already. But all those countries that have more variable rate debt, if they're able to trim their interest rates, that actually can impact their consumers and businesses a little bit more rapidly and thoroughly than in the US. You could actually have a global led recovery partially due to US interest rate cuts, is ironically how this could go. I generally have a positive view on liquidity for the next 12 months, and therefore my view on Bitcoin is also positive for the next 12 months. They have a lot of correlation together, and the handful of times where we see Bitcoin break its correlation with liquidity, it's often due to valuation extremes. There's a bunch of different ways to measure Bitcoin valuation. You can look at like on-chain analytics and stuff like that. Generally, my favorite is market cap to realized cap, which is to say, market cap is like, what's the current price of the coin, multiplied it by how many coins there are. Realized cap is like the on-chain cost basis. It's like the current value of all coins the last time they moved. And so when you get those really big bull runs, sometimes market cap can get way ahead of realized cap. Whereas other times, market cap is not that much higher, or it's rare cases below realized cap. And those tend to be less dangerous from like a valuation standpoint. The sentiment and the overbought status is less extreme. So when we look at that, I expect liquidity to go up over the next year, and I don't see any signs of like extreme Bitcoin valuation. That combination generally leads me to be pretty bullish on Bitcoin.